Marine Insurance Act 1906. International marine insurance is primarily regulated by national laws, supplemented by international conventions and agreements, and governed by established principles of insurance law. While there isn't a single, universally enforced international body, various international agreements and practices help standardize the industry. However, the Marine Insurance Act 1906, UK remains a cornerstone of maritime law, providing a structured approach to risk allocation in global trade. While some provisions have been modernized, its core principles, insurable interest, utmost good faith, and defined loss categories, continue to shape marine insurance worldwide. Its adaptability ensures relevance even in contemporary shipping, though supplementary laws and market practices now complement its framework. The Marine Insurance Act, MIA, 1906 is a UK statute that codified the common law principles of marine insurance and came into force on January 1, 1907. The act was designed to bring clarity and uniformity to marine insurance law, which had previously been based on judicial decisions and mercantile customs. Although the UK has since updated its insurance laws, example, the Insurance Act 2015, the MIA 1906 remains highly influential globally, serving as the foundation for marine insurance laws in many Commonwealth countries, including India, Australia, and Singapore. 1. Definition of marine insurance, Section 1. The Marine Insurance Act, MIA, 1906 defines marine insurance as a contract where the insurer agrees to indemnify the insured against losses incidental to marine adventures. This includes not only ship and cargo risks, but also related financial exposures such as freight charges and liability for third-party damages. The Act recognizes both voyage policies, covering a specific journey, and time policies, covering a fixed period. 2. Insurable interest, Sections 4 to 15. A fundamental principle under the Act is that the insured must have an insurable interest, a legal or financial stake, in the subject matter at the time of the loss, though not necessarily when the policy is taken. This prevents gambling on maritime risks. For example, a ship owner, cargo owner, or lender with a mortgage on a vessel has an insurable interest. If no such interest exists, the contract is void. 3. Duty of utmost good faith, Sections 17 to 20. Marine insurance operates under uberrimi fidei, utmost good faith, meaning both parties must disclose all material facts affecting the risk. If the insured conceals or misrepresents key information, example, the ship's poor condition, the insurer can void the policy. This principle was later relaxed somewhat by the Insurance Act 2015, which introduced remedies for innocent non-disclosure. 4. Marine policy requirements, Sections 22 to 31. The Act mandates that a marine insurance policy must clearly state the insured subject matter, example, cargo, ship, freight. The risks covered, example, perils of the sea, flooding, piracy. The voyage or time duration. The sum insured, in valued or unvalued policies, to slip a preliminary document may precede the formal policy, but the policy itself is the legal evidence of the contract. 5. Warranties, Sections 33 to 41. Warranties are strict conditions that must be complied with. For example, seaworthiness warranty. The ship must be fit for the voyage at the start, for voyage policies. Legality warranty. The adventure must be lawful. Breach of warranty, even if minor, historically allowed insurers to deny claims entirely, though modern reforms, example, the Insurance Act 2015, now require the breach to be causative of the loss. 6. Voyage and deviation, Sections 42 to 49. The Act regulates changes in voyage, example, altering destination, and unjustified deviations, straying from the agreed route. Unless permitted, example, to save the lives, deviation discharges the insurer from liability. This ensures predictability in risk assessment. 7. Types of losses, Sections 55 to 63. Total loss, either actual, ship/cargo destroyed, or constructive, recovery costs exceed value. Partial loss includes particular average, loss borne solely by the insured, and general average, losses voluntarily incurred for the voyage's safety, shared proportionately among all stakeholders. sue and labor clause, requires the insured to take reasonable steps to minimize losses. 8. Measure of indemnity, Sections 67 to 78. The Act provides rules for claim calculations. Valued policies pay the agreed sum. Unvalued policies compensate based on the actual value at the time of loss. Abandonment. In total loss cases, the insured may transfer ownership of the wreck to the insurer, abandonment, for full indemnity. 9. Subrogation, Section 79. After paying a claim, the insurer inherits the insured's legal rights to recover damages from third parties, example, a negligent shipowner. This prevents double recovery by the insured. 10. Double insurance, Section 32. If the same risk is insured with multiple insurers, the insured cannot profit from overlapping coverage. Claims are apportioned among insurers to prevent overcompensation. Current status and global acceptability. 1. Legal status in the UK. The MIA 1906 remains in force, but has been modified by later laws, including Insurance Act 2015, softened strict warranties and introduced proportionate remedies for breaches. Consumer Insurance, Disclosure and Representations Act 2012, protects consumers in non-marine insurance. Many of its principles, example, utmost good faith, still apply but are interpreted more flexibly today. 2. International influence. Commonwealth countries, nations like India, Australia, Canada, and Singapore have laws heavily based on the MIA 1906. International trade. The Act's concepts underpin modern conventions, example, Hague-Visby rules, and are referenced in Lloyd's policies. Non-Commonwealth jurisdictions. While some countries, example, the U.S., have their own marine insurance laws, the MIA 1906 remains a benchmark. 3. Criticisms and modernization. Strict warranties. Historically seen as harsh, leading to reforms like the Insurance Act 2015. Digitalization. New risks, example, cyber threats in shipping, require updates beyond the 1906 framework. Arbitration and dispute resolution. Many marine insurance disputes now rely on arbitration clauses rather than strict MIA 1906 interpretations. Thank you for watching the video. For more marine topics, please subscribe the channel. Please help us with your valuable feedback to improve the contents.